In this video, I'm going to show you why the profit in your business is not inside your business bank account. This is the number one thing I see business owners not understand. They have this false sense of security when they see their profit and loss report. They say, whoa, I made all this profit. And then they get confused when they look at their bank account in their business, and it's much lower than their profit. So in this video, I'm going to walk you through this kind of graphic I made to help visualize why that profit is not in your bank account. So at the top, we have our revenue. So this is money coming into your business. You sell a product or service, a customer gives you money for that product or service, and you deposit that money into your bank account. Everyone understands what that is. That part's easy. After our revenue, we have expenses. So cash is spent on things that are going to provide immediate value that help generate more revenue. And when I say immediate value, things like rent payment, utilities, payroll expenses, insurance. If you pay for rent for this month, it's only good for this month. You don't pay for the rent in May and you're like, oh yeah, I don't have to worry about the rest of the year. It's like, no, that rent payment for May, that provides immediate value just for May. So money comes in from revenue, you spend that money on expenses, and after that, we have our net profit. And as you can see here, net profit, it's profit, bottom line, whatever you want to call it. It's just revenue minus expenses. And that part you probably understand, but you probably misunderstood it in the terms of, okay, cool, like money comes in my business, money goes out of my business. So why is my bank balance saying something else? There's because in accounting, there's 3 more categories that are going to explain why money's leaving your bank account, but not affecting your profit. So top of the list, we have assets. So in your business, cash is used to pay for things that provide future value. And notice how I differentiate expenses and assets. Assets provide future value. Expenses provide immediate value. So if you make a down payment on a car, which I have here in this little visual, you make a $5,000 down payment on a car, you're buying an asset that's going to help you make more money in the business in the future. So that $5,000 reduces your business bank account and increases an asset account. It doesn't show up as an expense that decreases your profit, because it's going to help you provide future value in your business. It's going to help you pay bills or make more money in the future. That's what an asset is. So like inventory, down payments for equipment, stuff like that. So asset is the first reason why your profit is not showing up in your bank account. The second reason is liabilities. So in your business, cash is used to pay for debts owed to others. So easiest example is a bank loan, like an SBA loan. Maybe you get a loan for your business and you have to pay $2,000 every single month. That $2,000, it reduces your bank account, but it doesn't show up as an expense. It's reducing your bank account and reducing a liability on the balance sheet. Maybe a little bit of that loan payment will be able to be expensed, and that's the interest portion of it. But all in all, you see a loan payment, you see $2,000 leave your bank account, just know that's not an expense that's going to show up on your profit and loss report. So after assets and liabilities, there's one more thing, and it's equity. So in your business, cash is going to be transferred to the owners to pay them. So owner draw, a distribution, these terms might be familiar, but basically if you take money out of your business bank account and put it in your personal bank account, it's going to reduce your bank account in your business, obviously, but it's not going to show up as an expense. You as the owner are taking money out of the business. This is going to be an equity transaction that also shows up on the balance sheet. And after all that is said and done, what's left over is your cash flow. That's going to be what you're looking at in your bank account, your checking account. That's your cash flow. Positive cash flow means your bank balance goes up. Negative cash flow means your bank balance goes down. So as you can imagine with this example, profit is good to know, but a profitable business can go out of business because the cash runs out in the bank. So in my opinion, cash flow is the most important thing. You want to have a business that can, in normal operations, generate positive cash flow. You don't have to run a business that relies on having cash come in from bank loans or your own money just to keep the business running. You want a business that can generate positive cash flow. You want a business that can operate and the bank balance is consistently going up just from normal day-to-day operations. Now, honestly, in my experience, assets, that doesn't happen too often. It depends on what business you have, like if you're e-commerce or something, or you have inventory. But the common thing I see all the time of like, all right, why is my profit not in my bank account? It's because liabilities and equity Oftentimes I see a lot of business owners, they'll have loans, or worse yet, they'll have merchant cash advances, which are absolutely awful. And they're making these payments every single week, even every single day sometimes, or just once a month. This money is leaving their bank account, but it's kind of silent because it's not showing up on a profit and loss report, which is the only report anyone ever wants to look at. No one wants to look at the balance sheet or statement of cash flows. So liabilities and then equity. I see so many business owners, they just transfer money from their business bank account. They'll transfer like $10,000 from their business bank account to the personal bank account. And then the next day be like, how come there's no money in my business bank account? It's because you're transferring it. It's because you're transferring money from your business to your personal bank account. So I'm not going to make this video too long. Hopefully this made sense and this visual graphic really helps tie everything together. But in short, and just thinking about cash, you collect cash from customers, comes into your business. Money is leaving your business through expenses, and what's left over, you got your profit. This is what you're going to be taxed on during tax season. And I recommend setting aside like 20%. Talk to your tax accountant for the exact percentage, but set aside 20% every single month of whatever your profit is. There won't be a surprise tax bill. But then after profit, just start looking at your balance sheet or statement of cash flows and start looking at, all right, did I make any down payments on new pieces of equipment or vehicles, or did I buy inventory, or did I make a security deposit for rent for this new office that I just started renting? So start looking at assets, liabilities. Did I take on new loans? Is my current loan payment really high? Do I have to refinance it? Start checking out your liabilities. And then finally, look at your equity. Look at how many times am I withdrawing money and just transferring it to my personal bank account? Or worse yet, personal transactions. All those credit card swipes at the strip club, that's not a business expense. What a surprise. All those little visits to Publix, if you're an HVAC owner, you can't just expense those Publix visits. Those are all things that you need to pay attention to, because these three things, the assets, liabilities, equity, that's the explanation as to why your profit is not in your business bank account. But I'll cut the video short here. If you have any questions, you want to see more videos like this, let me know. If you want access to this kind of PDF graphic that I created as part of this small ebook I made, let me know in the comments below and I can send it to you. But like I said, I will stop the video here.